our long-term thesis doesn't change. We're making a bet on, in this region, in the MENA region, a transformational step from basically an analog way of life into a digital way of life. That's what we're doing. If you think that now is a good time to be investing because pricing or valuation has rebased, then what were you doing in 2021 and 2020? In 2021, your game as an investor has got to be go into the companies that are going to be able to use capital as a moat and punch a hole in the market as strong as they can.
Welcome to Culturenomics with Arjun. The show aims to unravel the layers of the fintech sector and the rapidly evolving tech startup ecosystem across the MENA region and beyond. I am your host Arjun, and I will be inviting founders, executives, investors, regulators, and other influential stakeholders to discuss and dissect the highs and lows of their own ventures and how they foresee the wider ecosystem evolve. Join us as we celebrate success and the spirit of risk-taking, the candid discussion that goes past the timid question and cautious answers. This show is produced in collaboration with Adyan, a reliable end-to-end payment solution that enables businesses to turn payments into a strategic growth driver. We're also brought to you by Lulu Financial Group, a global financial services provider headquartered in Abu Dhabi and operating in 11 countries. Finally, Culturenomics with Arjun Singh is brought to you by M2P Fintech, Asia's leading payment infrastructure company that enables businesses of any scale to embed financial products. Welcome to today's episode of Culturenomics with Arjun Singh. I'm your host, Arjun. Today I'm joined by Tammer Qaddumi.
Yep. Good.
I got that one right.
Yeah.
Who's a partner at VentureSouq, which is a multi-strategy VC headquartered in the UAE. And actually recently raised $50 million to invest in fintech across the MENA region. I think enough with the introductions. Let me say hello to Tammer. Tammer, welcome.
Thank you.
It's not the first time we're meeting.
No.
Right?
Won't be the last.
Yeah, and we'll move the last. And I was saying that, do I really need to be on this show? Should we just open the question and leave the floor to you?
I'll just run.
Yeah.
I'll just go a cappella.
Okay. Well, I think the first question might require you to, right? So we were having a great time in 2020, 2021, all sorts of startups and fintechs, whether they were early stage or late stage, were getting funded quite healthily. Q1 came, we've seen a substantial drop. Certain sectors have been hit worse than others in terms of VC funding. If I was to pick one, I think InsurTech took I think a bigger nosedive than the others. Some say that there's over 200, somewhere in the region of 250 billion dollars of dry powder around, but the VCs are not as forthcoming, if I may have to use the word. People are still getting funded though. Some very interesting fundings have happened in the recent past. Mm-hmm. So what's changed according to you? What's happened? What's your take on the situation?
Yes. Something has definitely changed. We got a warning shot in March 2020. And from our position as a venture capital firm, and a venture capital firm that had invested into lots of startups, in our, for the size that we are, a relatively large amount of money over the preceding couple of years. And so March 2020, we went through this kind of flurry of activity where we are taking stock on life. We convened a big group of our portfolio companies, gave them the words of caution about how they should be careful about preserving cash and focus on preservation over growth for the time being, and companies that go through a soft market environment like this and come out of it are going to be stronger on the other hand. It's kind of like words of encouragement. Number two, kind of like looking at our own portfolio and stress testing stress testing valuations and what does that do for our IRR? What does that do for our narrative? This kind of stuff. Looking at our own cash flow as a business. So we went through this and then kind of like, okay, what do we do if the next 2 years are really, tough? We went through that. And of course it bounced back, very quickly, more quickly than I think anyone on our team was expecting. And so now we get to this point in time and it definitely feels different. It definitely feels that there's something more profound. There's sort of like a pervasive negative sentiment that is not reactive to some very specific market event. It's kind of like, it feels systemic. It feels like it's sort of like multi-factor, and therefore there's something that's like that's got more permanence to it, and so it definitely feels different. But the warning shot that we had in March 2020 kind of prepared us for this. Now we have somewhat of a script that we can just kind of like repeat, and we can reconduct those exercises. I will say that our long-term thesis doesn't change. A venture capital firm, differently to a hedge fund or a private equity fund or other types of funds, have long-term horizons, 8 years plus 2 years of extension, sometimes 10 years plus 2 years of extension. And so you're taking longer-term views, and you are investing into companies when they're very, very early. And so you conventional wisdom says if you're a guy or a girl who invests in seed, Series A, Series B stages, you're kind of shielded to a certain extent from market turbulence that happens, particularly that turbulence that comes from the capital markets. You're shielded from that, or you've got time to ride that out, and so the game is different for you.
So I get that. 2 points before you go further, right? So the advice of being prudent with the cost side or the cash side of the business and trying to drive towards profitability are not bad ideas, irrespective of the season, right? So irrespective of whether you're good times or bad times. And I have no idea if VCs were encouraging. I've heard that certain VCs were encouraging a number of startups to say, forget this whole profitability bit. All we want you to do is focus on growth, spend money left, right, and center. We need to kind of grow number of customers right now. And I do understand that whole sort of, you acquire and then you engage and then you transact and that whole sort of model. But I do think some people got away, right, with it. So I think that advice holds true. I don't think VCs should be rounding up the portfolio companies only when the timing is hard. The other bit here is, let's be honest, most, I guess, fintechs which have IPO'd in the last 12 months have had a horrific period in the public markets, right? You've obviously got interest rates which have gone up, right? So cost of capital has gone up. I think the war in Ukraine and Russia hasn't helped for whatever it's worth. The U.S. economy has gone ahead and printed so much cash, which has driven the inflation. So I do appreciate that on one hand, you could say, you're correctly saying that the VC industry, at least early stage VC, is protected from some of these market forces. But I don't think that's actually played out the way it is, right? Because those are the sort of the dominant forces which have influenced this sort of drop in the VC funding. Correct me if I'm wrong, right? If I take that same argument forward with you, if you feel that the VC industry is still protected from some of these sort of macro forces, then are we going to expect an equal amount of deployment of capital from, let's say, VentureSouq going forward, as it was in 2020 and 2021? Or are you also going to get more selective than you were previously?
Yeah, I think there's a lot to unpack in that question, and it's a good one. It is a good question, but let's take a look at what are we actually doing? Like, what are we actually doing? We're making a bet on, in this region, in the MENA region, a transformational step from basically an analog way of life into a digital way of life. That's what we're doing. And if it's kind of like, look at e-commerce penetration in MENA, and it's still, I don't know, under 5%. It's probably closer to 3%, versus in North America, it's like north of 20%. It's probably closer to 30%. And so we're way behind. And then extrapolate that, like e-commerce is probably one of the more advanced segments. I think in other parts of the world, we saw over the last several decades an iterative adoption of technology and improvement of user experience and empowerment of consumer that has resulted in an economy behaving in a certain type of way, and VCs being subject to certain risks, and a whole different opportunity set in MENA, where okay, we're still, this is just a leap from where we are now to where we need to be. And there's a lot of runway there. There's a lot of space for these companies to grow. So that's what we're investing into. And that's what I mean by, okay, if that's your view, then if the market turbulence, causes, certain anxieties, the goal is to sort of figure out how to deal with those anxieties in a mature, responsible, make safe, like sound business decisions. So now what are we on the pace of spending? It is that is a function of, because ultimately this comes down to the question of, all right, if you think that now is a good time to be investing because pricing or valuation has rebased, then what were you doing in 2021 and 2020? How do you defend that you were?
Thanks for asking the question.
Investing capital at that time, and then also have a bullish thesis saying now is the right time to invest. And I think that one way to look at it is that you are companies. If that's the paradigm, you're moving into the digital arena, and there's just a lot of room for you to grow. Well, in 2021, your game as an investor has got to be go into the companies that are going to be able to use capital as a moat and punch a hole in the market as strong as they can, so that they are formidable players at the time. In the period when the times are good. So when the market is strong, who is going to be able to take a Series A and then flip that into a strong Series B like 6 months later, and then flip that into a strong Series C like 6 months after that, and they use this like bull run to really punch a hole in the market in a strong way. Then they okay now. And we did that. I think that we did, whether or not we were intentional with that strategy, we ended up backing those types of companies who now are in formidable market position, albeit with precarious cash flow situation right now. Now the goal with those companies becomes preserve, maintain a level, like compromise growth, and focus on stability and maintain the level. You've already punched a big hole. You're already a formidable player. People already have to contend with you. Sit on the level that you are. Plateau your growth where you are right now and ride it out. So extend the cash as much as you can. But you've already gone through this hyper growth where you're taking capital, investing it, growing. You can deal with a couple of years even of plateaued growth where you are making sure that everything works in the business. And so that's where we got to guide these companies. What's the difference between 20 and 21 and 22 and 23 is that you are investing into this process of punching a hole in the market, and you are in 22 and 23 you're investing into businesses where there is strong linkage still between existing traction and the price that you pay. You become more price sensitive over the next 2 years for sure.
So let me make a statement and then I have a follow-on question. I think in a lot of ways, specifically for the region, I don't think what's going to happen over the next 6 to 9 months is particularly a bad thing. I think a lot of businesses which were Me Too and had no differentiation or no moat, unfortunately will fall by the wayside. I think we're going to also have businesses which didn't have sustainable business models, or their economic models never made sense in terms of, being able to get that profitability in a period of time which was acceptable. I think will fall by the wayside. So I do think that there will be a cleansing of the scene a little bit, which isn't a bad thing for those. Now, I feel bad for a number of founders because a lot of their dreams are locked into their ideas, but unfortunately their ideas were just not good enough that'll happen. The question I have is, a number of these businesses might not have sufficient cash to sustain that plateau, as you say, for the next 2 years.
Yeah.
Right? Because either they overextended themselves in that period when they were punching the hole, as you put it. I like that. I'll use that again. Right? These companies are going to come back into the market or are requiring to come into the market to either raise debt, equity, whatever it is. Right? But for the ones who are actually going into the next series, right? Are they going to have to take some haircuts on their valuations?
Yeah, they might. And that is something that we worry about. I'm not going to take credit for this kind of like idea. I'm not going to give credit, but this is not a like Tammer original thought. Those companies need to do. There's two ways of looking at like existence or survival at this period of time, and one of those is okay, cash burn, and how many employees are you able to keep and how many do you have to let go, and the other is looking at from a cap table perspective, what is funding now at recalibrated valuations gonna do to your cap table, and most importantly from a standpoint of incentivization and almost like morale of your existing stakeholders, including founders and employees and early investors. So you need to be able to absorb capital at a level that doesn't punish any of the stakeholders that are important moving forward. And I would argue that every stakeholder that you have ever had in the company is important to keep happy. It is a dangerous game, and in our experience, and this is more like anecdotal than it is like I don't have data behind this, but where companies have dealt with situations where some stakeholders get alienated and others are rewarded, pay to plays, severe down rounds where earlier investors get squeezed and liquidity preferences come in. When that happens, we've seen very few situations where that results in like positive outcomes. You need for everyone to still be bought in and optimistic about where the company is going, because so much of the success ultimately is on narrative. So much of the success of businesses it's like a professional athlete. You've got to have confidence. No matter how good you are, you have to have this like swagger. You have to have belief all the way through your bones that you're the best. And so that's what you've got to like. That's the second level is of survival through this period. And you could come out of this period even stronger. But the second level is
businesses were built during.
Absolutely, but the second level is that you've got to be able to absorb capital in a way that's not gonna piss off stakeholders. Pardon my French. No. So but like here's the funny thing is there an argument to say that those companies that brought in capital at the highest valuation, those that would be most criticized for bringing in companies at high valuations, are in the position to absorb more capital without diluting founders or earlier investors, and in a way take care of the investors who came in later, like by giving yourself more equity firepower, that actually arguably you are in a position to work out a solution where you can absorb more capital in tough times because there's more equity value to play around with. So, and I think we got to tease out that like scenario. But if you follow what I'm saying, if you look at a company that was valued at $200 million when they should have been valued at 50, well, now you've got a lot of equity to play with that you can absorb against, and you could issue those shares in a way that makes people make whole. That makes people feel like they are being made whole. I think we got to be creative to make sure that that's not.
The point is that yes, you have to be creative, but it is unfortunately it is a zero-sum game, right? Someone will gain, someone will lose.
Not necessarily. And I'm not deflecting away from taking that question head on, but I want you to think about another point, which is that a startup enterprise, economics 101, enterprise equals capital plus labor, some coefficient times capital plus some coefficient times labor, right? That's what enterprise is. What we are doing, what venture capital is doing, is saying we are going to provide capital at some coefficient that gives the companies that we're backing a competitive advantage to fight for market share and grow, and therefore get us outcomes that are important. So or that are meaningful for us. And so effectively what we are doing, the higher the valuation the company is successfully able to bring in capital, the higher the capacity for additional capital becomes. The capacity, the ability for that company to get big. If you were to sell most of your equity down the river early, right, by valuing yourself too low, then one way is like, did investors, you could look at that by the deal that the investors got. Did they get a good price or a bad price? But another way to look at it is that you've actually constrained the ability for that company to bring in more ammunition later to fight the war that you want it to fight. And therefore, and that's the valuation bull argument, is that by putting the company in a position where it can absorb more capital in the future if times are good or times are not good, then you are teeing up the possibility for success, big time success, and you're arming the founder with that. And then good times, bad times, bull market, bear market is really a function of speed. And so in the bull market, okay, let them raise a bunch of capital in 6-month intervals. In the bear market, be careful how much capital you bring in, and do that in 18-month intervals. And so it's
how much equity you give away.
Yeah.
And I think that's the exam question, which we possibly can't answer here, because the scenario is, yes, capital gives you that headroom. It depends on how much equity you've diluted, right?
Yeah.
If you've over diluted, then unfortunately you're not in that same situation, which you just sort of mentioned.
Yeah, you're constrained.
Yeah, you're constrained much heavily.
Yeah.
And obviously this is subjective to each cases. Let me switch questions. This can be a Tammer special, or it could be patented to Tammer. So you're an early startup. You want to raise an early round here, right? What should we do differently, right? So what's the story you bring to the VCs to sort of rise up the pack? Has it changed?
Yeah, it's changed. I think that whether we were explicit about it or not, like we sit around and we make decisions. We have a team of people who are all super strong, all super opinionated, and for lack of a better word, we can get into the nuances of exactly how we make decisions. But it's a democracy. It's a janky democracy, and so and we sit around and debate. Everyone studies up, and then we sit around and debate which companies are good and why. And so in 2020, second half of 2020 and 2021. There is a lot of emphasis on the founders or the company's ability to raise. Are they going to be able to play that game? Are they going to be able to match others? Like, if capital is a moat in and of itself, because what the way you exploit that market opportunity is by punching a hole in the market, and you do that with money. Then how good is this founder at raising? Like how good are their relationships? How good are they in front of a room? You're literally thinking through that. Maybe we're not explicitly talking about that, but it is how much confidence, how much swagger does this person have? Does this team have?
More like Shark Tank.
Yeah. Yeah. So that changes now. Now it really does become more about testing product market fit, evidence for product market fit. This thing is working, right? And then let's look specifically on uses of funds and exactly what the inputs and the expected outputs are. How long can you stretch that? Where do you want to be at the next, like what this 2 million or whatever that you're raising, where does that take you? And we have the benefit of time now. I mean, one thing that's definitely changed in the last like 2 months is that the founders, we got 18 months of let us know next week, or else we're closing, and then it's 3 days of like negotiating for more time.
Yeah, I can tell you that as an angel, that's happened,
right?
Even though as a big VC.
Yeah. And then that has totally changed. Take your time. We'll give you all the documentation you need. We'll talk to you. We'll talk you through the plan. So it becomes more about. It really does become more about validating product market fit and defining precisely how that's going to be measured, and then getting as close to visibility around that as you can, and then making the bet. Spending money. But again, like how we started the conversation: seed, Series A, Series B. You invest through the cycle. You have to. That's otherwise. You can't be playing the game where you're I'm not a macroeconomist. I'm not predicting when cycles are going to happen. But I will say that amongst the VentureSouq team, I was bearish, or I was a voice of like, hey guys, is the market top-ish? Is this the right? In like 2019, we would have absolutely missed a cycle, and it would have like almost like killed. There's an argument to say it would have like killed the company. If we sat out the last 2 years when Mina Venture was like popping like that, and again, it's like we got a long-term view here. We got a giant leap for all mankind. This is not an iterative. This is not a small step. This is a giant leap that's happening, and you've got to take part in it. And if we would have gone by my fearful sentiments, we would have sat out exactly the time when we should have been flexing, and so fortunately, we got other people who.
So this is a great time to it's a great segue into. Let's talk a little bit about VentureSouq. I'm gonna put the questions straight up because I like the way you answer. Give us the genesis of VentureSouq. Where did it come from? Right? How do you guys all get together, put it together? Right? What have been some of your standout investments over the last X number of years, and looking forward, what sectors, what types of geographies are you focusing more on, if that's part of the philosophy or not?
Yeah, I think that it's my favorite subject. Yeah, exactly. So
I remember having a cup of coffee with actually we had dinner. I think it was what 6 years back, 5-6 years back. You, Sonia, and Ramesh, Professor Ramesh.
Yeah, that's right. Yeah,
that's kind of when we first met, right?
Dr. J, we call him Dr. J.
Dr. J. That's when I was working with him setting up Start AD.
Yeah, that's right. That's right.
Okay, cool. Sorry. So go ahead.
Phenomenally important partner in our history.
Yeah,
Start AD. Maybe the most important, one of the most important partners for sure. But so we were we were a group of people that kind of naturally, organically came together, and really it was a personal interest slash vanity project of investing into startups. There's young people with some disposable income, and let's invest into startups and let's brag about our startup portfolio to other people. That is kind of what it was. But there was also this thing where the traditional way of capital movement, all of us kind of recognized from our various perches. One of us has a legal background. One has an insurance she's an actuary. One of us is on the strategy. Kind of came from large multinationals, primarily in the media space and on the strategy side. So we have different vantage points. But and I have a private equity background. But it was kind of like, the way that capital moves doesn't really work really well, and we can do this in a better way. So early on, it was like, the democratization of capital. We can do that. We can activate the long tail. Let's go and find people like us, and let's catalyze that, and then that can become a powerful, force that could become a powerful pool of capital that becomes meaningful to someone. And so that's the genesis. And then there's been all sorts of sort of iterations. We then, so starting out with a kind of a group, a decentralized group, then it became clear that this body needs a head, and so some of the core members need to become service providers, and then everyone else in the network, and by the way, the network grew pretty fast. Maybe there were at that time, I don't know, 300, 400 investors that were looking at deals with us. Everyone else needs to become a customer, and then we need to provide good, sufficient, and then eventually good customer service to those customers. And that is when kind of that changed. We became VentureSouq proper, and we incorporated, and then we ran syndicates. We put together little multi-investment portfolios and raised capital for those. We serviced corporates and family offices, and then eventually we got to the point where we could brag about a portfolio and defend our own, that we're good enough to manage other people's money, and we raised a fund. But the reason, what I think is super interesting about our genesis that I often emphasize is that, like, if you look at what's happening with DAOs, if you play around on Discord, it is at the core, these things are tools to allow a large number of people to share information or ideas, and then pool their resources together for the benefit of projects. And that's a really hard thing to do. I think that the technology, the tool, what's going on in Web3 and blockchain allows you to do it in a way that I don't think we would have been able to do it when we started our group. But we had the same. We had the same fundamental thesis. We were looking at it the same way. And so it's really exciting to see the stuff that's going on now. Like it clicks intuitively.
So give us your 3 standout investments.
So
I'm sorry,
we've had so many great investments.
I'm sure you do.
on the fintech side. By the way, our portfolio now, through all of these different permutations of our business, we've got a portfolio of over 250 companies. I would say that we, like, where we're strong is that by hook or crook or however we did it, we ended up being able to access a really global portfolio. And this is not us like indirectly this is us directly on the cap table of almost all of these businesses, early stage on the cap table of many of these businesses, and some of them completely knocked it out of the park. I think that we have done to date, knock on wood, extremely well on a whole segment, which is like the ledger book segment.
Okay.
Now, that is in emerging markets around the world. There's this very common practice where the guy in the Bacala will give credit to his customer. He knows the customer. He knows where they live, and he gives credit to them, and he does it on a notebook. And here's a simple software that we can give to the merchants. The merchants have absolutely no friction in adopting that ledger book, but all of a sudden that gives you data between these merchants and their relation and their customer relationships that becomes like really. That's a big set of data. That's many relationships that you're now sitting in between, and that becomes a valuable base to build upsell products. And so we did that in India with two companies, one called Khatabook and OK Credit. We did it in Indonesia, and then we with the fintech fund. Once we launched that, we did it in Pakistan. We did it in Egypt.
Who did you invest with Pakistan?
Credit Book.
Tiger
then came in and invested, and that gave some validation. But it is not. The game is not over. Like, it looks good. It looks like we've done well, but the game is not over. The verdict has not yet come down on that business model yet. Okay. So that's
it is getting hotter and hotter in this segment.
Yeah,
it is.
Yeah.
So I guess part of the verdict is the affirmation that more and more people are pouring themselves into this. So I only say part of the verdict. Okay.
No, I think that's just comforting. That's not. That doesn't write a check.
I'll stop comforting you. Right? Let's.
No, I need it sometimes. Yeah. I think that. So what are the standouts? I think Husby is a standout for us. I think it's a great business that if you look at other kind of what is prop tech largely, many of these people are positioning themselves between two sides of a transaction, whether it's a purchase of a unit or a mortgage being written or a rent agreement being entered into. You're in the middle of that and you're taking a piece of it. And one way is to take product and put it directly on your platform and let the market come and fulfill that demand. And you could have stock sitting on your platform for weeks or months while that matching happens. And the way that Husby has done it by going through the brokers, you have literally hundreds of brokers that are doing tens of transactions a week, and you're getting, albeit a very small, but you're still getting pieces of the transaction, and it's just by the model of it, it's so much easier for them to ramp up their GMV in a big way. So I think it's very, very smart what they've done. I think that our friend Hossam is a breakout.
He's a breakout, definitely.
Yeah, I mean, we forget because of how much that segment has kind of like popped off and how visible it is as a fintech firm.
It gets a disproportionately high amount of ink.
Tabby or BNPL? BNPL, exactly.
Yeah,
and by virtue of that, Tabby.
But by virtue of Tabby, but the fundamental thing, I work with Tabby. I think I was merchant number one for them in the Middle East. I'm not sure.
Yeah.
Correct me. I think the one thing which set that company apart for me when I was evaluating was the fact that there was a founder there who actually understood commerce very well and had successfully sort of done something in the past.
Yeah.
And that's not taking away from some of the other BNPL players, but for me, that's what set that organization apart from the others.
Yeah, 100%. So, but we love all of them. The most recent deals that were announced, like in the last couple of weeks, one was Zenda, which I think is phenomenal.
So I met Raman the other day. We actually celebrated that round. So
yeah. We did North Ladder.
I'm aware of North Ladder. Yes.
I think everything that we've done has the potential to be like everything.
All right, so then let me hold you. So what's next? Are we going to continue doing the same thing? Are you looking at new sectors? Are you looking at this whole Web3 stuff going on?
We are. Yeah, we are. And there's also first of all, if you want to make the case, there's a lot of kind of like smoke and mirrors, and there's a lot of like editorial opinion about Web3, and but there's one unavoidable fact, which is that the talented people are flocking,
are gravitating.
Yes,
and that is, yeah.
The young talented people. If you're like not thinking about decentralization as a principle, if you're not thinking about blockchain, then
you're missing a point.
Yeah, you won't get the people. And if they don't, actually, there's a guy on our team who espouses. I don't think anyone on the team gives it as much importance as he does. But his primary criteria whenever we're talking about a company is this does this appear to be a company that people like me will want to go and work for? That's like if you look at his,
it's a great
criteria. Yeah,
great criteria.
Yeah, if you weight his criteria, it's like, okay,
disproportionately.
Yeah, team will do that on a scale of 5, and market size will do that on a scale of 5. Attractiveness to employees, we're gonna weight that at like 25 or 30. So depending on where you score on that category, you're gonna get his vote.
I think that's pretty cool.
And they're going into that segment for sure. I think that we have done very well. Again, a lot of the stuff is like look retroactively at what we did and then say that there was a thesis behind it, frankly. But we were able to assemble a global portfolio of companies, and then those companies have networks. We have relationships with those founders. Those companies have networks. They have co-investors that we then get to know, and then that becomes the most valuable thing by far for the companies that we invest into.
I totally agree.
That's really what do they want to know? Like, there's all this value add, this and that. What do most of them want? I want intros to other VCs. I want intros to international VCs, and I want intros to people at companies that do the same thing that I do. Mm-hmm. What I want the most is if you could put me in touch with the head of marketing for the earned wage advance equivalent of me in South Africa. I would die to talk to that guy. So if you can deliver that by virtue of being like exposed directly to a large number of international companies, then that's the best service that we can provide to our local companies. And we are taking the same approach in crypto. We've got another product. We have another vehicle that is getting global exposure into what we think are the most exciting projects in the world, and that should deliver a return. But importantly for us, that allows us to represent ourselves as having the connectivity that you need to be valuable to people that are building here in MENA. So same playbook.
Tammer, we'll never be.
I can keep on going.
We'll never
get started.
We'll never have enough time. But we have run out of time. I think we'll definitely have you back, Sonia. The other Sonia and your fourth.
You can have all the Sonias.
I can have all the Sonias, right? Well, I only know one of them personally, but the other one you will introduce me to. But hey, thanks for coming in.
Yeah,
right? As always,
pleasure.
It's always a pleasure. I think we've got a couple of conversations due in any case on a couple of startups, which I want to introduce you to. But with that, thanks a lot again. I hope I haven't taken too much time of your evening away.
Not enough.
But not enough, right? I'll take that as a compliment, right? Cheers, mate. So with that, ends my discussion with Tammer. As I said, Tammer is a partner at a multi-strat VC called VentureSouq, headquartered in the UAE, but investing all over the globe and investing in multiple sectors. With that, I'll say goodbye and see you at the next episode. Bye.